basically, if you're sitting in cash on the sidelines, for lack of a better phrase, he didn't say it like this, but like you're a fucking idiot, you need to get the money invested. About to get real. Cash Flow King with you today, and in today's episode we have the Fed rate cut begins. Time to get rich again. Hope everybody's doing well. As always, thanks for listening to the show and tuning in. We really appreciate it. I've been trying to strong arm one of my advisor buddies. We just started texting shortly before this recording. I think he was going to go by the Masked Advisor. And his response to me so far is, I'm not job optional like you two, talking about me and one of the other guys yet. Trying to get him to come on the show. He's being a chicken shit. And so it's possible this recording could get interrupted and take a turn here midway through my episode. But I've tried to get him on before. I'm not holding my breath, so I'm not sure what's going to happen there. I'm going to assume that I'm just going to be solo on this one. And we could be pleasantly surprised. But anyhow, hope everybody's doing well. Thanks for listening to the show. Premium memberships now dropped to $3 currently. So if you're not premium, please consider supporting the show.
Premium!
You can read all about it. Click on the link in your show notes to become premium today. All right. So let's see here. A lot of stuff going on, a lot of headlines out there, a lot of talk out there. And at the end of the day, I really think that nobody knows anything, and anybody that tells you otherwise is just completely full of shit. So one thing we do know is that the Fed came out recently and cut rates 25 basis points or 0.25%. What does that mean for you in English? The short answer is, for some things we've already started to see the impact and effects, and for other things we don't know and won't know for some time. So for example, for deposit products, anybody that's using something like a high yield savings account, you've probably already noticed, and if you haven't, you'll soon notice that interest rates have started to come down. If banks and financial institutions are able to pay you less on deposits, they certainly will, and they'll be very quick to point to the recent Fed cut of 25 basis points as the reason for that. There was one institution in particular, I won't name them on a general show like this, but they were paying, I think it was 4% for the longest time, and they recently, after the rate cut, dropped it down to 3.6. I think they were holding it a little bit, I guess you could argue, artificially high for some time, and I knew there was going to be a time where they would go ahead and cut, but instead of just cutting, in this case, to match the Fed funds rate cut of 25 basis points, they went ahead and cut it 40 basis points, and they put it in an email at the very end. They were very quick to call out the fact that their interest rate on margin loans has gone down, and very quick to compare that to other brokerages out there. And then at the end it was, oh, by the way, our deposit rate has also gone down. So I thought that was pretty slick on their part as far as making that announcement, really just sneaking it in there. But there's a lot of people that are, trying to figure out, scratching their heads as to what's going to happen. And so I've listened to several podcasts, I've read some different articles, and some are more interesting or entertaining than others. But at the end of the day, like I said at the beginning of the show, I really don't think anybody knows what the fuck is going to happen. My own personal opinion is that rates will likely continue to decline. And generally speaking, at least in we'll call it the short to midterm, that's probably a good thing for a lot of investors. However, on the back end of that, it could spell trouble way, way down the line. And maybe we'll circle back on that here towards the end of the show. But there is one economist in particular who does a video newsletter, and I haven't sent it out. Maybe I will to the premium folks. I don't know. Like I said, on general episodes, I'm very hesitant to promote certain things. And, there's a lot of people that listen to this show. However, he's been talking about this now for quite some time. And basically on his most recent, not even his video newsletter, but he was on a podcast as recently as this morning, where he basically talked about essentially a 3-step combo process, trifecta, whatever you want to call it, and kind of where we're at now. So, one, relatively high tariffs, he mentioned. Number two, threatening to remove military protection for retaliation against those tariffs. In his opinion, both of those things have already happened. We haven't necessarily seen all of the effects of that. And by the way, I'm trying to get Big D to come back on here as a follow-up to our episode we did quite some time ago with regard to tariffs. So that might be coming out relatively soon. He's going to try to get on here. So I was hoping to record with him possibly today, but that's not going to happen. But hopefully he'll get back on here soon. Anyway, number three is essentially pressuring to devalue the dollar and meeting with those same, is what this economist calls the intimidated allies, right? And so I'm not going to get political on this show. We don't talk politics on this show, but there's a lot of people that are of the mindset that, the current administration is trying to essentially attempt a Federal Reserve takeover. And a lot of people think that's well underway. Other people think that maybe not so much, but it seems like things could be going that way. Now, when we talk about or hear about rates coming down, what exactly does that mean? As I started to say, well, for certain things like deposit products, you're going to see reductions right away. For other things like variable rate debt, whether that's HELOCs or credit cards or whatever the case might be, you may also see that in the short term come down a little bit, but I think a lot of institutions are going to be dragging their feet and maybe bring that down a little bit more slowly. But those are all short term effects and ramifications of the Fed funds rate coming down a quarter point. But then there's some other things, and I think where a lot of people are looking and really, quite frankly, scratching their head right now is with regard to, okay, how does this affect things like mortgage rates? Because, there's a lot of talk out there about housing and affordability, and I actually have a meeting coming up this week with a younger couple that was referred to me by an existing client who are considering whether or not it's going to make sense for them based on their situation to buy their first home. And that'll be an interesting conversation. I don't have all the info yet, but we'll see how that conversation transpires next week. But there are a lot of people, younger folks in particular, that are kind of, scratching their head on this, because I think everybody, or a lot of people, the quote unquote American dream is pitched to all of us, to go to school, get an education, get a good job, put money in your retirement account, buy a house, have the 2.5 kids with the white picket fence and blah, 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 blahs, right? So, and for some people, maybe it works out that way, and for others, it may not. But one of the things that, and I might have said this on the show before, I don't really think that there's any shame in renting. Now, that's not going to be the right answer for everybody, but I don't think that home ownership should be put up on this pedestal that a lot of people, at least historically speaking, have put it up there. And I know that there's a lot of folks that are of the mindset in terms of financial stability and just, quote unquote, making it or doing what you're quote unquote supposed to do, that somebody should buy a home. And again, I don't think that's the right answer for everybody. I'm not saying it's a bad idea, but I've said this from day one. I had a debate quite some time ago, I think with Equity Stacker on the show, where your home, in my opinion, in the opinion of many, is not an investment. It is an expense. And I personally look at it as a lifestyle decision. So yes, we own a home. We could rent if we wanted to. We could own the home if we wanted to, which is what we choose to do. But not for 1 second do I fool myself into thinking that that's an investment. It is simply an expense, and it is a lifestyle decision, and different people will choose to own homes or not for different reasons. And that's not what today's show is about, so I'm not going to spend too much time on that. But the point is that as rates come down, so as the Fed funds rate drops, that's not directly correlated to mortgage interest rates. And I think sometimes people are surprised that there's not necessarily an immediate effect. However, they are tied more closely to the yield on a 10-year treasury, which is often a benchmark thing to look at in the financial services world for many different things, different types of products that are interest rate sensitive. But it is possible, and personally I do think, especially coming into the end of the year and, depending on how things go, particularly going into 2026, that mortgage rates could come down even further. Do I think they're going to go back down to where they were a few years ago, where people were locking in rates at 3%, in some cases sub 3%, even 4% for some people? No, I don't think so. Do I think they could get down into the fives? Quite possibly, yes, I do. Will that happen? I have no fucking idea. So I don't really like to make predictions, even though I just made one, but there's a lot of people out there that feel one way or the other. And it seems to be, looking at the information that's out there today, I don't really think that anybody necessarily knows. And I think it's leaving a lot of folks, whether it's first-time home buyers and or real estate investors, kind of scratching their head. And, obviously, if mortgage rates do come down a little bit, that's going to bring additional demand, generally speaking, to the market, because you're going to have more people from an affordability standpoint that can now afford to purchase a home because they can afford those payments that are going to be presumably lower based on the fact that the interest rates have dropped a little bit. However, what that's also going to do, just based on simple supply and demand economics, is that's basically going to increase the price on a lot of these homes, right? And so I don't know necessarily that this is going to solve the housing affordability, quote unquote, crisis that a lot of people are talking about, but I do think it could bring new buyers to the market. And I think where a lot of people have struggled, myself included, from a real estate investor standpoint, specifically when it comes to single family rentals and just buying rental property or investing in rental or income property, especially with debt or using leverage, is, okay, do I want to go ahead and lock it up now? Because if I purchase it now, I'm basically locking in the price, which generally is going to go up over time, and it could go up pretty significantly depending on the market that particular home is in if rates were to come back down. So do I want to lock in the price today by making the purchase today, even though the interest rate on that mortgage is higher than I would like it to be? Or maybe that it doesn't quite cash flow the way that you would want it to be, and maybe it doesn't cash flow at all, right? And those are all questions that we all have to deal with as investors. It's something that's been on my mind for quite some time. And there was at least one, maybe two homes, and I might have talked about this on the show previously, rental properties that I purchased when I didn't think the numbers were all that great. I wasn't overly thrilled with locking in mortgage rates in the sixes, which is what I did. One was at 6.375. The other one was at 6.5, which is by far the highest that we have. Most of the other ones are in the threes. However, that's a decision that I made. And quite frankly, if for one of those properties, and I actually got a text about it today, I've been blowing this fucking guy up. We get texts and calls all the time from wholesalers trying to buy properties. And let me see if I can go back to my text string here. Where did he go? Yeah, Kyle. This guy writes me and says, "Hey, this is Kyle, just reaching out to see if you consider selling," and he puts the address in, "any price in mind." And I pretty much, came back at him and put it back at over $100,000 more than it was worth. Asked him when he could close, and I dropped it by $1. Then I just started being an asshole. "You buying or what? Kyle, how much you trying to pay?" And then I started sending him little memes and stuff like that, just fucking with these people because they like to waste my time. So, I don't care to throw it back at them. But the point is, there is one house, that one in particular, that I would consider selling for the right price. It's really not done what I expected or wanted it to do from a cash flow standpoint. And it's been a couple years now, and I've been waiting and waiting and waiting. And quite frankly, if I had to go back and do it all over again, I probably would not have made that purchase, specifically with the way that I financed it. And maybe that's a story for another day. But there was another one I bought a year after that, which actually has worked out quite a bit better. And I am happy with that purchase. And it does cash flow a little bit better than the other one. And the rate is essentially the same. It's 6.375 as opposed to 6.5. But the purchase price was very similar. The rents were very similar. In fact, they're identical now. But, they were off by $100 a month before. And so you just got to be careful. And I'm not here to tell anybody what to do, right? Like we always say, we don't give advice on the show. We don't give recommendations in the show. This is for information, ideas, education, entertainment, bullshitting around with some dude on a podcast that, likes to get on here and talk from time to time. And so that's what it's all about. But there are some people, and there was one fairly reputable, large real estate investment source recently. I was reading through some of their stuff, and the gentleman on there that runs that show and wrote that particular article was basically saying that he's advising people now to go ahead and lock in because he doesn't necessarily know or think that rates are going to come down precipitously on the mortgage rate standpoint. And that if you're going to squabble over a very, very nominal amount, I think he used, 10 basis points, which is essentially nothing, just to go ahead and get it done, and you can always refinance later. And that is one part of that argument that I agree with. Some people say, well, you marry the property, you date the rate. You can always, at least in America, you can go ahead and lock in in a lot of cases, a 30-year fixed interest rate mortgage. And if rates come down enough, you can always refinance that later. Yeah, you're going to have some costs that are associated with doing that. You're going to reset the amortization schedule. There's a lot of considerations and things you need to think about when it comes to that. But it's not necessarily the worst idea. But I do and have, like I said, struggled with it before. Like, all right, well, let's just go ahead and lock this up. And if rates drop, I'll refinance it later. But the thing is, it has to make sense, at least to some degree today. And I guess that's kind of a good segue into the idea of speculation versus investing. And at least recently for me, my mindset when I'm looking at highest and best use of a dollar has changed a little bit. As much as I'd love to buy another property, for example, by the end of the year, and I may or may not, it has to cash flow. And if it doesn't, if I choose to go ahead and buy that anyway with the thought that maybe I'll refinance it if rates drop precipitously in the future, that's in a lot of ways speculation. And I had a little bit of money that was tucked to the side, and I was debating, do I want to go ahead and buy another single family rental with this and put some debt on it and get a loan at today's rates, or do I want to put it into something else, specifically a syndication? For those of you that listen to the show pretty consistently, I generally love real estate syndications. And there's some that, have gone okay. There's a couple that have gone very badly. And there's some that are doing, pretty well. And a couple of additional new real estate syndication investments. I think I've made 3 this year into 2 different syndications or 2 different funds. And one of them I recently re-upped and increased my position in that fund. But to compare and contrast, to me, that particular fund and what they are doing, which is what a lot of them will attempt to do, is buy assets where there's some sort of a built-in hedge or built-in buffer there. So if I buy a single family home with a rental now at an interest rate that's not attractive, that doesn't cash flow, then you could say that, yeah, there's other, ways that you could measure total return on that. And we've talked about that on other shows, so I won't get into that now. But you could make the argument and say, well, that's really speculating. That's not really investing. But if you bought something or invested into a fund that purchases assets that have a built-in margin of safety, because these people are getting these off-market deals where they're instantly, even if they don't do anything to them, because they're typically buying from mom and pop sellers, going to appraise for more than what they actually purchased them for. And they have these value add plans to go in there and pretty much improve the net operating income, right? You want to increase income, reduce expenses, all those sorts of things. That might be a better play. And oh, by the way, depending on how you're investing and the type of fund you're investing in, a lot of times you're still going to get the benefits of things like pass-through depreciation, just like you would if you own the asset directly. So anyway, that's what I decided to do personally, was to increase my position in one of those funds. And like I said, I've made, I think at this point, 3 different investments this year, including the increased position in 2 syndications that are essentially going after, they're income focused, but you're making an investment because you pretty much know what you're getting on the buy. And one of the reasons that, and maybe I'll do a separate podcast on this if people are interested, I don't know if you are or not. If you are, or if you're not, email the show, realtalkpersonalfinance@gmail.com, and happy to get into it if you want. But this one particular fund that I increased my position in, I mean, they're acquiring assets that are essentially irreplaceable. They have a couple parking garages in there. There's some mobile home parks in there. And some of these locations, again, I don't want to say too much on a general podcast like this. Maybe I'll do a premium episode on it. I don't know. But you're getting cash flow from day one. You're getting instant equity from day one. You're getting all the benefits of depreciation. And oh, by the way, you don't have to lift a finger once you do your due diligence and wire the money. So, for me, that made more sense to do now because it's going to cash flow now. Anyway, like I said, I don't want to get too detailed here. But the point is, are you investing or are you speculating? And it's okay if you're speculating as long as you know that you're speculating. I watched a review on a particular deal recently, which was more of a kind of angel investment type of startup in the agricultural space. And the folks that were essentially doing the review and talking to the operators, once they dropped off, they were pretty much like, yeah, this is more of an angel investment. This is more of speculation. This is more of, hey, I have my fund money, and if I want to take a swing and take a shot and put some money into this thing, maybe I would, but it's not where they're going to put their big dollars that are meant to do the heavy lifting for a large portion of their portfolio. So what does all that mean for you? I don't know. It really depends, and I think it's a good time for all of us to take stock of what we're doing and how we're positioned. So one thing that personally I've been thinking about, because the writing was on the wall, right? I don't think this Fed rate decision of 25 basis points cut was news to anybody. In fact, a lot of people will argue that that was already priced into the markets, essentially, right? And they're saying there could be a couple more this year and potentially going into next year if you look at things like the dot plot and all that shit. But who knows what's actually really going to happen. But I think knowing that that was going to happen, usually one of the first things when rates move, the Fed funds rate moves, is thinking about and looking at those deposit products. If you think about it, where are you going to get the money to make an investment? Now, if you're investing in your 401k or your Roth IRA, those are all great things too. Typically, you're dollar cost averaging, right? Money's coming out of either your bank account or your paycheck pretty frequently, and that's one thing. But if you're looking to make additional investments above and beyond that, whether it's in a syndication or a rental property or anything else, could even be the stock market, but you're just looking to make that additional investment, chances are you have a pile of capital somewhere that's sitting there that's not currently invested, that maybe, presumably, is just sitting in some sort of money market or cash equivalent, some kind of high yield account or whatever, that's collecting a little bit of interest before you pull the trigger. And so thinking about that and thinking about, this particular allocation, and it wasn't a ton of money that I added on, it was a decent chunk, but it wasn't anything like out of the ordinary, but that money's somewhere. And so I had to think about like, okay, what does our liquidity position look like right now? And what are the thresholds that we like to have things at? Where do we need to be? And if rates were to go down and this pile of money or this chunk of money started earning less, how would I feel about that? And would it be better served if it were invested? And don't get me wrong, there's definitely a degree of risk that comes with any investment versus a deposit product, right? So those two things are obviously not the same. But if it's money that ultimately would be or could be invested, but you're just trying to put some extra padding around your liquidity buckets or your liquidity position, then does it really need to be there or not? And I knew that if rates dropped and I had a little bit of extra, quote unquote, that was sitting there, I wouldn't particularly like that. And so with that in the back of my mind and knowing that I'm an investor for the long term and kind of looking ahead, I was looking for a place to deploy it. And if I found that place, which I did, but as I was looking for that, if it made sense to move forward, great. And if it didn't, I would have left it where it is. I think where a lot of people, and I'm kind of partially speaking to myself here, for additional dollars or additional investments above and beyond what I just alluded to, that it's easy for us to say, well, shit, the interest rate on this account went down. I'm not earning as much interest. Fuck it. Like, I want to earn more. This is bullshit. And you may bite off more than you can chew or invest maybe more than you otherwise should. And it's easy to chase. And that's something that I'm trying as an investor to get better at, because, could I put more in? Sure. Did I want to put more in? No, not really, because I've gotten better about these liquidity positions and making sure that things are topped up to where they need to be and having those thresholds, right? And so I think that while it sucks to watch rates come down and your deposits earn less and everybody wants to get invested, and don't get me wrong, like, I agree with that. At the same time, you don't want to do that to your own detriment and wish that you had that money back later, because you may not be able to get that money back later, especially if you're going into some sort of illiquid investment like I am. And so those are just things to keep in mind. The other thing is, again, depending on your time frame and what you're looking to do, especially for those that may have a rapidly approaching non-negotiable sort of deadline, and probably the best example of that, I guess, would be retirement. Well, if that's the case, you should probably be doing some retirement income planning in general, and that's, kind of a whole separate conversation. But even from an investment standpoint, for those that are, fairly well set, maybe they have certain guaranteed income sources like pensions and or Social Security or whatnot, rental properties, whatever, okay, that's fine. But they still have a pot of money that they'd like to invest as they approach retirement, and they want to grow that pot of money over that particular time frame, but they want to insulate themselves and hedge out from a risk standpoint. But just know that there are products out there, especially if you're used to stock market type of investments, that do exist really regardless of your age, that you can have, and there are always going to be pros and cons and limitations, but you can have some sort of downside protection. So back in the day, they were popular at one of the firms that I worked at. Again, not going to name names, but there were different types of what we would call structured products where you could invest in something that has a very specific risk profile depending on what you were looking to do. Maybe losses were capped at a certain percentage, or there was some type of a buffer where you were insulated from the first X percentage of those losses. And if things went well on the upside, maybe there was sort of a multiplier where, there was some leverage involved and your return could be greater than it otherwise would be. And you got to be careful with those things. Again, going back to liquidity, because a lot of those are illiquid. And so, you want to know absolutely what you're getting into. I don't think that's the answer for everybody, but I do think that, they could be part of somebody's portfolio. And then getting into those that are older, and when I say older, some people are going to be offended by this, but I'm talking, 50s, 60s, possibly even 70s in some cases, where you are closer, or if not already retired. There are some products that can do that are annuities that have these same types of characteristics to structured products. Some of them are more complicated than others, but a lot of them will have some type of a buffer or a floor or something where you are at least somewhat insulated from the downside. Now, some people are going to hear that and say, well, bullshit. If I want to be invested, I understand the risks and the ups and downs. I don't want to sacrifice upside for potential downside protection. And in certain investments, I can get on board with that and I can see that. But in other types of investments, you might be pleasantly surprised to find out that you're really not giving up that much, if anything, on the upside. In fact, sometimes you can actually earn more that way than if you didn't do a product like that, and you can still be insulated at least somewhat from the downside. And again, if there's interest in stuff like that, and you guys want me to do a separate show on different types of products like that and dig a little bit deeper, peel back the onion a little bit, I can do that. Just, again, email the show, realtalkpersonalfinance@gmail.com. But those are also possibilities. So whether it's, depending on what your investment style is. For me personally, we have products like that we help clients with. Sure, if it fits their risk profile. Personally, at this stage in my life, would I use something like that? Probably not. But my risk profile and my situation is going to be different than the next person, which is going to be different than the next person. So you really have to figure out what works for you. But I think, again, a lot of people are pleasantly surprised just to learn that there are products out there like that exist. And so, as long as you're working with the right advisor and they're taking a look at your entire situation, it's possible you may be able to find something that you can at least take some of the risk off the table, because nobody really knows, going back to the beginning of the show, nobody really knows what the hell's going to happen, right? A lot of people are thinking, well, job market softening and unemployment ticked up a little bit. And so, rates came down, but that's not necessarily a good sign. How stable are jobs? Oh shit, maybe I shouldn't invest because I have to have my liquidity buckets, which again, that's all valid. And other people are like, I listened to a podcast this morning, and again, I'm not going to name names, but The Economist is actually on that podcast, and the host was like, hey, basically, if you're sitting in cash on the sidelines, for lack of a better phrase, he didn't say it like this, but like, you're a fucking idiot. You need to get the money invested because shit's about to go to the moon again. Now, is that going to be true? I don't know. If I was a betting person, do I think that markets could go higher if rates continue to go lower in general? I'd say, yeah, probably. But at the end of the day, I think Mark Cuban pretty much sums it up and says it best. And for those of you, I'm sure everybody knows Mark Cuban, but he's been on Shark Tank. I think he owns the Mavericks. Like, he's a pretty out there, pretty famous guy. And according to him, according to this recent article on MSN, the best way to build wealth is to, quote, have appreciating assets, whether it's a home or a mutual fund, something that can appreciate over the long term, which is pretty fucking basic. And again, going back to my initial point about houses, I don't think your personal home is an investment at all. And even if you consider it to be one, I certainly, if you run the numbers, it's not a very good one. But it could be with anything. I guess the point is, and this kind of corroborates what this other podcaster was saying, and I agree with, you want to own assets. So when I looked at titling the show and said, hey, the Fed rate cut begins, is it time to get rich again? What I'm alluding to is, in the low interest rate environment of before, there was some uncertainty out there. There was, people didn't necessarily know what was going to happen or not. And I think I've told this story on the podcast before, but one of the scariest, and looking back, probably one of the best things that I did, and I just got lucky, but also had to have a little bit of confidence in myself, because nobody really was able to talk with me, because at the time they weren't really a thing. But these DSCR, or debt service coverage ratio loans, where you could basically, they're not all like this, but a lot of them, you can cross collateralize a portfolio. I was able to do a cash out refinance on a portfolio of single family rentals, pull all my money out, go from a weighted average of just over 5%, 5.01%, down to 3.75%. My payment went up a couple $100 a month, and I pulled all my money out and was able to reinvest that elsewhere. And at the time, I had asked people that I had looked up to, and other people in the industry, even that weren't in the industry, and people are like, what the hell are you doing, Cashflow King? I've never heard of this before. Are you sure about this? Well, looking back, locking in 3.75 fixed for 30 years is probably one of the best things that I've done. In the meantime, those assets continue to cash flow, they continue to appreciate, inflation is debasing the debt, on and on and on. And so that's essentially what I'm talking about. I don't think rates are necessarily going to go quite that low, but whether you choose to invest in real estate or not, or choose to invest in the stock market or not, or choose to invest in both, or whatever you're doing, asset prices generally, when they go up over time, bodes well for those that actually own assets, and it's not going to be a good thing for those that essentially aren't investing and don't own assets, and that could be assets of any kind. And so does that mean take every last penny that you have and go dump it in something? No, it certainly doesn't. It just means that we could potentially be seeing the next wave of asset appreciation, and that could be followed by some things that really aren't that fun. Nobody really knows what's going to happen. And I guess the whole point of this podcast is to say, look, after about 9 months or so, the Fed finally decided to drop rates a quarter point. They're saying they're going to continue to do it. Nobody really knows what's going to happen, and they could change their course, right? Like I said, I'm not here to play economist, and I don't normally make predictions, but my thought is now is a good time, especially coming into fourth quarter. Take a look at your situation, take a look at your financial position, and be in a spot where you can make decisions, hopefully from a position of strength, and therefore you can get invested, you can stay invested, and it just may turn out that it's the next wave, the next uptick, and hopefully that will do wonders for your financial situation, for your net worth, and you can see things continue to go in the direction that you ultimately want them to go in. But at the same time, it may not necessarily go that way. There's people that are a little bit scared right now. There's people that think that we could be in for some rocky times before in the Fed might pivot again before they continue to lower rates. And who knows, what's going to happen. And, with all that said, if you're kind of thinking or feeling that way, going back to what I mentioned about some of these built-in hedges and the types of investing that you're doing, that could be appropriate. Personally, like I said, I take more of what a lot of people would refer to as a barbell approach. So if you think of essentially a barbell, like a weight barbell, right? You got a fucking long ass bar. Let's say you're going to bench press something, right? You got the long bar, and you got some weights on one side and some weights on the other side, and really nothing but the bar in the middle. And that's kind of how I look at it from my financial position standpoint. You want to make sure that things like your insurances and your estate plan and your cash and everything you need to play defense basically on one side of that barbell is there. I don't really have a ton in the middle area. I'm not one of those that's going to be like, oh, I'm freaking out and I'm scared, so I'm going to put my money in bonds and blah, blah, blah. Not that there's anything necessarily wrong with that. That's just not my style. On the other end of the barbell, I'm fucking balls out, right? 100% equity or stock exposure on the stock market type stuff for the most part. Real estate investments, I tend to like things that are more income focused or oriented, not necessarily growth oriented. But I play a lot, and we talked about the capital stack, in the equity position, not so much on the debt position. Again, nothing wrong with private credit and debt, But I have a tendency to have, one portion of the financial position or portfolio way on one side to play defense, make sure that's covered. And that allows me to sleep at night and be comfortable and go way out on the other side of the barbell where the other stack of weights are on the other side of that barbell for my investment side. And I think where a lot of people go wrong or sometimes get it wrong is they end up somewhere in the middle, or maybe their position's not where they want it to be, and maybe they end up finding themselves in a situation where it's like, well, yeah, I'm kind of forcing this, but the first side of the barbell is not intact, so shit, if it doesn't go right, I need to jump in and out of the market. I need to sell at the bottom. I need to do things that I shouldn't otherwise do or have to do or feel like I have to do because the barbell doesn't have the first. I hope this is making sense. The first part of the barbell is not structured the way that it needs to be. So they just put shit on, in the middle or on one side, and then all of a sudden if it starts to slip or slide a little bit, then they're like, oh fuck, I don't have anything on the other side to stop it. Those little almost looks like a hand grip thing. You can kind of like squeeze it, and the circular part opens up a little bit and it slides on the end of the barbell, and then you let go of it and it tightens up around the weights, just kind of holds it there in place, That's kind of what I think about when I think about something like that. You want to make sure that first stack of weights, let's say on the left-hand side of the barbell, has that piece around it. And so no matter how much you shake that bar, if you drop that bar, if you lift it or move it down or rotate it around, those weights aren't going anywhere. That's locked in. That's how I think about the left side or the initial side of the barbell. And then you can do whatever you want on the other side. So I hope that makes sense. Again, that's not going to be everybody's strategy, but I think it works well for me, it works well for us, and that's probably what we will continue to do. But with that said, everybody does things differently. There are products out there with hedging, built-in hedging, and like I mentioned, things like that. So you got to figure out what works for you. But the bottom line is rates were cut for the first time in 9 months. Nobody knows what's going to happen in the future. They could continue to come down. Asset prices, therefore, potentially could continue to go up. And you want to make sure that you are positioned in the way that you want to be so that you're not chasing. So if you haven't already thought about that or done that, I would say now is the time. Not advice, not a recommendation, just entertainment, education, and hopefully that sits well with you guys. If you got any feedback or want to deep dive on any of the things that I mentioned today, please email the show, realtalkpersonalfinance@gmail.com. Premium, again, drop down to $3 a month. Pick it up while you can. I'm going to jack it again in Q4. That's it. We will see you in the next episode.
Check the mic and make sure it sound right, boys.